David, actually, that's quite interesting because we just described the big picture and trends with Jacques. When it comes to Iris Capital, the pattern is totally different. What you're trying to defend here is a multi-corporate kind of pattern and strategy versus other kind of funds and VCs. Deep dive into it, please, for 10 minutes, and then we'll have a conversation together.
Thank you. Thank you, Jacques. Hello, everyone. So actually, Jacques, thank you for your presentation, because indeed we are in the business of helping companies growing fast and trying to avoid them dying slow, or at least easing it. And the way we try to do that, Iris, is to make large corporates and companies collaborate. So perhaps a few words about Iris Capital. Iris Capital, for those who don't know us, is a venture capital firm. We're quite historic. We were founded in 1986. We currently manage around 700 million, and we invest throughout the world in various types of digital companies, from seed to very late stage. One of our specificities is that we invest money that comes both from financial institutions, funds of funds, but most of all from corporates who really wanted to invest in startups and companies growing. And these corporates today are Orange, Publicis, but also Valeo, Bread, and BPI France. And quickly, as for myself, I invest in early stage startups. I feel comfortable being here with you because I started at Orange, where I led various activities from devices to innovation, then launched a startup in Europe, and then invested that so I could leave the various cycles and try to connect the dots between large corporates trying to innovate and small companies doing that innovation. Because that's our first statement today. In this grow fast or die slow world, we've seen a tremendous acceleration in the pace of companies growing. And we think we live in an amazing era where it is now extremely accessible for people to start companies. We've seen, thanks to all the people in this room, the cost of infrastructure going down, and now launching a company through a cloud service costs a couple of thousands of euros versus hundreds of thousands 10 or 15 years ago. This has generated more innovation, more entrepreneurship, more success, who have reinvested in the cycle and become role models for people in a society. And today we live in an era where even students during their course in universities or school get trained to be entrepreneurs. They receive courses, master's degrees, and when we meet them, they're ready to start companies and take on the world. 1/3 of people in universities or engineering schools or business schools will probably try to launch a company in the coming years. So this creates an environment where we see more and more companies. And how does it impact innovation? Innovation for corporates today is a key stake, because we can see it progressively going from the traditional R&D that everybody has invested in to actually these entrepreneurs and startups trying to bring innovative and disruptive models and trying to make them grow fast. A couple of figures: the R&D in large corporates throughout the world, according to Fortune, is around $300 billion, and it has grown in 2015 from 4.4%. As a comparison, the money that corporates invest today in venture capital or in companies directly is much smaller. It's 4.4 billion. It's even 1% less than that. But it's been growing 144% year over year. We've seen a tremendous acceleration of corporates investing in companies, in startups, bringing innovation. And yet, we're not at the level of the US, where the typical example is Cisco. Cisco has been acquiring massive companies between 1993 and 2001, and these companies now represent 40% of their revenues. So we're, as venture capitalists, try to bridge the gap. But perhaps staying a little bit longer on how you innovate in large corporates. As you all know here, one is R&D. As you can see, the weight of R&D is still massive. But then you build strategic partnership with companies, and now we see you more and more investing in companies. And of course, what we'd like to see you doing more and more is acquire them the way they do it in the US. The amount of corporate money being injected in companies right now is accelerating at a tremendous pace. What you see behind me is a graph that shows you that corporate venture has been the most growing arm of venture over the past couple of years, 6 times. Well, the venture capital, traditional one, is still growing strongly, 3 times. It represents much bigger amounts. If you compare, it represents 11 billion versus 4.7 in 2016, but it still represents a massive amount. So Today, a corporate willing to choose the approach where they're going to invest in fast growth and innovation will be in between investing directly, still a small amount in the market but growing, or investing through large investment funds and gathering a firepower to invest in bigger deals. This is the model we offer to accelerate this growth of companies. To do that, basically, you can see an effect on the market. The market right now shows in France an increasing momentum in investment in companies. We've rarely seen that intensity in financing innovation, helping companies grow fast. And actually, in Q4 2016 and Q1 2017, France outgrew in terms of rounds and amounts, the amounts that finance companies in the UK and Germany, even in Israel and Sweden, which shows right now the intensity of capital placement. But also, it has an impact on the availability of funds. France, in the last quarters, has been the biggest country in Europe raising funds and generating new funds to provide money to these companies trying to scale without EBITDA, without profitability. So right now, what I'm trying to tell you is, this is an amazing time for innovation for startups. This is a very competitive time to find the right innovation for your company, and there are massive players to do that. So the model that we offer as a venture firm is to give you more leverage through multi-corporate. Why? Because if you invest directly, the amounts are smaller. If you get several corporates trying to invest together through larger funds, what you get is an actual firepower on the market. This firepower will allow you to play at a high level. You're the biggest fund, so all companies come to you to finance their growth, because right now the rounds are getting bigger, and companies with their ambitions want to raise not 1 or 2 million, they want to raise 5, 10 million, so that they can sustain that growth that Jack was talking about and go faster on the market. The second thing that they will look for is an increased capability to build a relationship with corporates, so that they have access to partnerships and reliability on revenue. This is what you can provide going through us, because when we meet companies, we can link them to the right corporate we interact with. And then, being able to invest bigger amounts in a larger deal flow gives you a probability of investing in more companies, as Jacques said, but also in the most competitive ones, so you get more visible presence. Couple of examples. When we launched our OPV generation of funds in 2012, Orange and Publicis invested 150 million within a 300 million fund. The first step was that we exchanged with them and we connected them with relevant companies for their business. Naturally, they grew more and more relationship with companies, and we saw appear in 2013, 2014, the first accelerator within Orange, Orange Fab, or the first collaborations between Publicis and companies we had brought in the US, such as Mopub or Flight. And then, naturally, since they got more and more involved with innovation and companies, they felt compelled to invest directly in more strategic amounts, in more specific companies that relate more to their environment, with Orange Digital Venture or with Publicis 90. This model has generated a few successes. A couple of examples. In the US, in 2012, we met Lookout, which is an antivirus for mobile. While they were starting to discuss with Orange, we invested a quite relevant amount with Andreessen Horowitz. And meanwhile, Lookout was deployed in all phones from Orange to keep viruses coming in. And now the company is a unicorn, as we like to say, because it raised a massive amount from Peter Thiel's fund. Mopub or Flight were companies bringing monetization to Twitter or to Facebook or to Snapchat, and they've built a successful partnership with Publicis in the US with Vivaki. They've been acquired since. Mopub by Twitter, it was a very successful exit. Flight by Snapchat. So we've seen that cycle of innovation, partnership, and then acquisition operate. And the most latest example in Europe worked too. Scality is a petabyte storage company, quite known, that interacts a lot with Orange. We've been able to sustain their growth by investing massive amounts. Open Exchange is our most recent investment in email, or Adotmob is a successful mobile RTB platform that's actually gotten closer from Vente Privée. These successes are great, and they show that the model of funding companies through multi-corporate funds operate. But the truth is, if you want to go through the end of the cycle of innovation, is by acquiring companies. And that's my last message to you. We do our job as ventures to connect you with innovation, to accelerate these companies, and provide a reliable future for innovation. But The next step, as you can see on this slide, is not to be willing to collaborate with startups or build relations. It's to buy them. In the US, the rate of acquisition by the GAFAs is still strong. In Europe and in France, only 6 of the top 125 companies that were polled by the French tech BPI survey was planning to acquire them. We need more acquisition so that this cycle of innovation gets through, success is spawned, and you get more innovation along the way for your companies. Thank you very much.
Thank you very much, Julien. As we're still setting up the scene together in this opening session, I would like just to have a quick question with you about the way that you are not going to be blurred by, the buzzwords of the moment, of the season, like AI, like blockchain. How do you actually prevent yourself when investing or while investing from being totally blurred by this digital palooza?
Can I answer?
Jacques, maybe, or Julien, maybe first.
Well, we set up these words, we don't follow them. AI is a big trend world. The truth is AI is to companies right now what code used to be in the last 15 years, meaning at first it's something that's revolutionary because it changes the way you operate, and then it's just a tool that allows companies to grow. So we invested in AI in 2014 in chief technology, for example, disrupting fraud detection for insurance, but that was 2014, that was before AI was a buzzword. Now we don't look at AI as the thing we look for, we look at a must-have for a company to be able to operate on a model. So actually our job is not to follow these trend worlds, it's to find the next ones. IoT was a trendy world starting 2015.
Absolutely.
You had to have invested before that. So our job is not to follow these words, it's try to find the next one.
Jacques, what about your perspective?
So I'm more of an outsider on this one, but I must admit it's something which makes my head spin. As an academic, we're always asked, are you working on this? And that's the latest buzzword. And by the time you've convinced one or two of your colleagues to look at the issue, it's not fashionable anymore and nobody cares. So there's a problem of keeping a semi... I mean, you don't want to be too slow, but you don't want to be too fast. And I think it's exactly the same thing for investment. The problem is don't look at the buzzword, look at the long-run trends, and you've got to figure them out for yourself.
Thank you very much. Now, we say high risk, high rewards, of course, but what are the next big territories where you see disruptors looming or coming from in 2018 and the years to come? Do we have to look maybe closer at specific territories like Africa, for instance, or other innovation territories, or do we have more to pay attention to fields in general?
On our side, so right now I think there's a huge innovation coming on health tech, because we've had, so the typical digital and software is done. We SaaS companies, we still invest in, but the truth is finding innovation in these spaces is not new anymore. What we see is transformation of what we call deep tech, deeper trends of modification of ways we used to do things for digital. So automotive is a buzzword, but the truth is we're far away from the self-driving cars. And so we need a lot of innovation for it to be happening. Health, big data will impact health, and we're still very scared about it because it impacts lives, but this will happen. And then on the next stage is probably, let's say, investing in what will change the natural infrastructure of our world, meaning transportation, meaning energy management, meaning even environment. So it's like a contamination. We manage the higher layers, we're getting deeper into tech.
Jacques, what about the
interesting.
global expertise?
No, it's very interesting because David began by speaking about the sectors. And if you take health, for instance, clearly there's huge amount of innovation which are possible in the technical treatment of health. Now there's also huge amount of potential for better health management, thanks to digitalization and so on. The problem is we don't know whether our social system, the economics of the health system, are ready to, for instance, have better integrated management of the health system and so on. And clearly in France, and I think in most of Europe, and certainly in the US, this is really a big problem. And so it's not only a question of what the technology is, but which sectors are ready to accept the rationalization which is entailed by digitalization.
I couldn't agree more. What we see is that we invest in companies and they're sorry for the buzzword, disrupting a pattern. But first, you need this industry to digest that change. And so that's what you said, it needs to go slow first, so that suddenly it accelerates. Fraud detection, we've been disrupting insurance, and suddenly they saw all these massive cases they had not spotted. Internet of Things, we invested in Netatmo. People were wondering what it was about to have a weather station connected at home. Now they connect their thermostats, they connect their cameras, they manage their homes from a distance. It goes now very fast. So really, it's about inception. It's about putting the seed in the right place to see if it takes. It takes a long time to grow, and that's where we interfere. That's where we bring money. But once it starts, there's a massive acceleration of these fields.
Investment is inception. I love that tagline. And by the way, if you're interested into the innovation in the health sector, stay with us until the end of this morning session, because we'll have a tremendous moment and interview too with Bertin Naoum, and we'll deep dive into what innovation lays for the future when it comes to health and robotics. Now, actually, speaking of, again, disruption and speaking of investment, there's been this huge trend, if you may, about being or willing to be a startup nation. Like, for instance, right now in France, we're definitely like standing for this word. We are a startup nation. But the problem that startup, what they do and that their job, they're just burning cash. I mean, you know that for sure by investing in a lot of them. Now, when do we have to become a scale-up nation? Isn't that the end game?
The moment you in the room acquires startup. I mean, we've seen the recognition of the tremendous quality of French engineering, of French business making. We have great companies, and we've had a rate of acceleration of success with more and more IPOs. We had Criteo, we had Talent, we were an investor in Talent. We've seen more and more companies being acquired by GAFAs, the latest of which being Zenly, for example. So we see people from abroad coming to us and acquiring. But the truth is, it's a virtuous circle. You will have successful innovation if at some point companies who innovate find a destination path which is either an IPO, which is harder in Europe because less markets, or an acquisition. So you'll see, let's say, the concretization of that model the moment corporates, rather than investing, will go deeper onto acquiring companies full speed so that they buy this innovation that will generate their revenue of tomorrow. Accor has started doing that massively. PSA has acquired companies, one of which was Mr. Otto. We've seen more and more corporates making that play. We need more playing that game.
Jacques, what about scaling up?
I'm hesitating. But actually, no, let me go on the, because that's something which bothered me in your presentation and in what you just said. For an economist, I think there's a little bit of problem of stressing too much the fact that startups are, their normal thing is to be acquired. Because I'm somewhat scared of firms acquiring startups, not so much because they're innovative, because you're going to use their technology, because you want to offer new services, but because they're disruptive and you are protecting your business by purchasing them. Economists have been really traumatized by how much Facebook was willing to pay for WhatsApp, where clearly, the technology was good, but Facebook has enough engineers that they would have been able to do it. If they were willing to pay $16 billion for WhatsApp, it's probably because they felt that there was a strategic threat. And so I'm a little bit worried that we stress too much the purchase by big firms as opposed to helping I know there's a trade-off and it's got to be both ways, but as opposed to helping the startup really disrupt the ecosystem as it exists.
I hear your point about preemptive play, companies buying startups instead of being disrupted. I think that given the responsibility of large corporates with their EBITDA precisely, it's usually more of a play of growth that they're looking for, but that can occur. There's another element which we did not discuss, moving back to scale up, it's the capability to scale globally. I think when you're a US startup, US is 230 million people now. You've got the US, and then you've got the rest of the world. It's caricatural, but that's how they think. When you're a French company, you need to launch in Germany, then you need to launch in Spain, then in Italy. Internationalization, so scaling up of a company is much harder because Europe is not at a stage today where for a French or a UK or a German company, actually, sorry, UK is not soon part of Europe anymore. But anyway, for a European startup, we need also to create the legal infrastructures for these companies to scale more naturally throughout Europe. And that would probably also answer your question about preemptive play. If they have a wider territory to grow in, which will provide scaling up easier, then they will grow fast enough for companies to buy them for the growth and not for the preemptive play.
And I'd just like to state for the record that no economist, neither investor, has been traumatized on this very stage. I hope so. Thank you very much, gentlemen, for your perspective. It was really interesting to have you both on stage this morning. I think they do deserve some applause right now. And actually, as you know, and as Jacques was mentioning it earlier this morning in this introduction speech, telcos are definitely on the hot seat when it comes to investing in this upcoming future and on the infrastructures. So for the next session, we're about to deep dive into what part should they play, and how can we actually make the most of it as an ecosystem. That's the second session of the morning.